In this session, let's start looking at correlation risk and a few concepts of correlation which are really impacting the financial markets. How the risk with respect to the correlation between the various entities and various other risks is contributing to an additional risk. That is what we are going to look at. So from that perspective, just getting started with a few basics around correlation. A typical thing that gets covered is we'll look at the concept of financial correlation. What do I mean by it? And what is the kind of risk that is driving it? In which areas are we using correlations, especially in finance? Almost all the major areas we are able to see. We are using it in investments, you will be using it in trading. Risk management uses the concept of correlations heavily. The recent financial crisis can very well be attributed to correlation, and even the regulators are mentioning the word of financial correlation as a part of their regulatory requirement. So all these, where all it is used in what context, is something which we will look at. And finally, we will also see what is the relationship between the correlation and other forms of risk. How is correlation linked with market risk? How is correlation linked with credit risk? How is it linked with systemic risk? All these things we are going to look at, right? So just getting started with the same. Whenever we use the word correlation, it gets defined either as a static stuff or as a dynamic stuff. When I say static, yes, I take one data set, the other data set. At one particular point, I try to find out what is the kind of interrelationship that is present, linear relationship that is present between this and this data set, which are the relationship between two or more financial assets at a particular point in time. I am computing that number on a regular basis, and once it is computed, it is the value that is associated with the correlation. It's not changing with time. When I'm saying 10-day value at risk, it is computed by taking 10 days data at a time, and or probably one single day value at risk is computed, and that is multiplied by square root of 10. So this is when I say static, it doesn't move day over day, and even if it moves day over day, it is computed for a period taken together, right? It's computed for a period taken together. So probably even when we are talking about the original Coppola approach for collateralized debt obligations, the default correlations are calculated for an entire maturity period of the CDO. It's not for today, tomorrow changing. So the correlation could be one defined on a static basis, or it could be on a dynamic basis. Means on a daily basis, I would be seeing whether the correlation has really improved, worsened, gone up, gone down, two or more financial assets, how they are changing on a daily basis, on a regular basis. That is what we are calling as dynamic correlation. One of the important areas where we would be using this dynamic correlation is in pairs trading. As a part of trading, we'll try to cover that pairs trading mechanism, which is otherwise called as statistical arbitrage mechanism, wherein I will see, okay, if X and Y are having very high correlation, means generally if this is up, this is also up. But the day on which I see their correlation has worsened, has gone down. Earlier, let's say the correlation is 0.9. But on one single day, I am seeing that the correlation became 0.75. Then my strategy is I will buy the one that has performed lesser, that has gone down, and I will sell the one that has gone up, with a simple assumption that the correlation will again go back to the previous level. That is what we are calling as pairs trading. We'll discuss about that pairs trading model quite in a while from now. Unlike that, there are a few other models, one called as a Heston model, which looks at the correlation as a Brownian motion of the two assets. So the first asset being the Brownian motion of the first one being dz1 of t, for the second one dz2 of t. The correlation is being looked at with respect to the Brownian motion of these two assets, and this is again a standard normal distribution with a mean of 0 and variance of 1. So there could be a few stochastic correlation models as well. All these things, they are more and more dynamic in nature, not static ones. So we really need to know whatever the correlation that we are measuring, is it a static correlation or is it dynamic? Now, what is this correlation risk all about? In financial world, we observe that because of the adverse movements that are there in the correlation between two or more variables, there is a financial loss coming up. A simple thing. Okay, let's say the correlation between the two assets is much lesser. Let's say it's 0.2. Now, what the portfolio management says, if the correlation between the two assets is much lesser, they form a good portfolio because they offer diversification, they reduce the portfolio risk, which is correct. But as time progresses, the correlation between them could improve, could increase to 0.8. Then what is happening? Whatever this strategy which I have adopted, thinking that it's a good portfolio, this is not becoming a good portfolio. This is becoming a risky portfolio because these two are moving in the same direction. They are not moving in the opposite direction. So that kind of losses which the companies are getting because of the adverse movements in the correlations between two or more variables, we are attributing it to the correlation risk. So from that perspective, what is that we are saying? As the correlation of the asset returns is increasing, the risk of the financial loss is also increasing, because as the correlation is lesser, they are becoming more and more diversified. It is becoming a much better portfolio. It is becoming a much better asset to be added into a portfolio, which will reduce the overall risk. But as the correlation between the assets is increasing, they are becoming more and more risky, because both of them either give me a profit, both of them will give me a loss, which means the risk is getting increased heavily. So that is what we are calling as correlation risk. And what we have seen even in the recent financial crisis is, when there is a systemic collapse, when there is a crisis in the economy, we see that the correlations between the assets are going to be much higher. Whatever was the correlation earlier, whatever was the diversification benefit the two assets were giving earlier, during a financial crisis, we expect that the correlations will take a downturn. And a few more things which could also be understood is the correlation risk could also include non-financial variables. A few economic variables like some kind of economic crisis occurring, the whole financial markets, all securities will move in the same direction, or a political event creating political unrest in the economy, almost all the stocks will show a downward turn. A political positive almost all of them will show a kind of improvement. So what we are typically saying is not just the financial variables, even the economic and the political variables also could change the correlation between the two assets. Even there, we need to be vigilant of. Then, just as a simple example, let's look at the credit default swap. Now, we know that in a credit default swap, okay, let's say A has issued a bond, right? So bond issuer, A has issued a bond and B has invested in that particular bond. Now for B, the risk is A will default. Now because B is thinking that A will default, B will purchase a credit default swap, which is like a protection on this being the reference asset. So if A defaults, C is going to reimburse the loss to whatever extent that A has defaulted, C is going to reimburse. That is what is a typical credit default swap. And to make sure that C is reimbursing, B is continuously paying a premium to C, and C will reimburse the loss in case A defaults. Now think of how correlation is really impacting here. Now what should be the profile of C here? Who should be the C that I need to choose? The C that I need to choose should be in such a way that A and C are uncorrelated or they don't have much correlation. Because if both of them are heavily correlated, heavily positively correlated, what can happen if A is not defaulting, C also will not default. But if A defaults, C also will default. Then why the need I need to go? What's the need for me to go for C for a protection? So I have to choose C in such a way that A and C, the correlation between them is much lesser. So what is where correlation is playing a role even in the credit default swaps. And the spread that we really need to pay, that is the kind of a premium that is getting paid by the buyer of the credit default swap. The premium that is paid to the seller is measured in terms of spread, and it is completely based on to what extent this particular entity can default. If the default probability of default of this entity is higher, the premium that is paid in terms of spread is higher, and vice versa. But along with the probability of default of this entity, what we are trying to bring in is we also need to see what is the kind of correlation that is existing between the two. Because if these two are heavily positively correlated, if this is going to default, there is a good chance that even this will default. I will not get my protection. So the present value of the CDS is going to go lower, which means the spread is much lower. But if the correlation between them does not exist, it means that if this entity is going to default, definitely this will not default, because they are not that related or they have a negative relationship between them. So even if this entity is defaulting, this will not default. So there is a kind of a protection. I am very much assured of a protection, which is resulting in the spreads being going up. Even if the correlation is too much negative, also there is a danger. See, too much positive correlation between these two, straightforward. If this is defaulting, this is also going to default. So obviously there is no chance that I will get my protection. So that's the reason the spreads are much lesser, especially when the correlation is very high. But if the correlation is completely negative also, close to -1, It means if this defaults, this will not default. If this default, this will not default. Fair enough, right? If this default, this will not default. But if this does not default, this can default. When this is defaulting, right now, in the first case, when this is defaulting, this will not default, I am very much safe. But think of the other route. When this is not defaulting, there is a chance that this will default because the correlation is almost -1. So this will default, which means this company will not exist. So whatever the premiums I have paid to that are waste for now. I have to take a new protection now, and that new protection would become more and more expensive for me, which means I don't even prefer a fully negative correlation between the two as well. So that's the reason what you could see is when the correlation is very much close to -1, we see that the spreads have slightly gone down, and this is the place where the spreads are at the maximum. When the correlation was around -0.3, 0.4, 0.5, we see that the spreads are the maximum. But again, as it has gone completely negative to -1, we see that the spreads have even fallen. And in this case, there is a possibility of a wrong way risk as well. Because as the default probability, now here the correlation is very high, the default probability is increasing, which means this entity can default, and because of this entity being a default, the exposure to this entity is because of the high exposure to this entity, even this entity is also unable to pay. So because of that additional transaction that I have got in, to protect myself, whatever the instrument that I have used to protect myself, that instrument is defaulting. That is where I am calling it as a wrong way risk. The instrument that I have taken in order to protect myself against a defaulting entity, against a referencing entity, that protection itself is defaulting and creating a loss for me. That's the reason I am putting it as a wrong way risk. And so correlation is really playing an important role even in this wrong way risk as well, right? Now let's see what is the kind of interaction that exists between the world of investments and correlation. How correlation is playing a role in investments. Probably the easier way for us to understand is the concept of portfolio management. There is a possibility that I can increase the diversification, and by increasing the diversification, I'm actually choosing the lowest correlation. Let me just look at through an example. I've taken two securities, HDFC and Kotak. Right, for the last 1 year, I have collected the data of them. Now let's say I want to find out their returns, the daily returns. I'll take the compounded returns, that is where I'm taking the logarithm, log the first one by the second one. So I'll call this as HDFC returns and I'll take Kotak returns. So HDFC returns are this, Kotak returns are this, and based on that I have computed it for so many days. Okay, so these happen to be my daily returns for each of these securities. Now let me try computing a few things on this. So for the HDFC, or probably let me take the HDFC as well as Kotak, let me take the average returns. The average return for each one of them, the average return for this is this much, whereas for this is slightly higher. So looks like the average daily return is 0.14% for HDFC and it is 0.23% for Kotak. I'll take the daily standard deviation as well. Right, when I'm looking at the daily standard deviation for HDFC return, it is somewhere around this, and for Kotak, it is around this. So 1.54% for HDFC and 1.67% for Kotak on a daily basis. Now, what we are trying to see is, if I'm looking at, let's say, the Sharpe ratio, right, under the impression that the risk-free rate of return on a daily basis, if I want to look at the risk-free rate of return, let's say I'm taking at around 8.5% per year, and I'm taking it over a trading day, so I'm dividing it by 250. So the risk-free rate of return is around, let's say, 0.03% per day. Now what I am saying is, in each of these cases, I'll try to compute the Sharpe ratio, which we have seen in the portfolio's case, the return on the security or the portfolio minus the risk-free rate of return divided by the standard deviation of the returns. So the Sharpe ratio in this case is this much and in this case is this much. So probably Kotak is giving a higher Sharpe ratio compared to the HDFC. Fair enough. Now what is that I wanted to see? Now can I reduce the risk to some extent? Now I want to club. Instead of investing, now here it shows that it's better that if I invest 100% in Kotak, it is going to give me a higher Sharpe ratio. But on the other side, there may be a kind of intercorrelation that is existing between the two. So from that perspective, I want to say that I want to invest some percentage. So now I want to invest some proportion, right, in HDFC and some proportion in Kotak. So let's say I want to invest 40% in HDFC and 60% in Kotak. Right, I want to invest 40% in HDFC and 60% in Kotak. Now what is happening here? The combo, whatever we have created, 40%, now the returns are becoming 40% times the HDFC returns plus 60% times the Kotak returns. So the returns are operating somewhere around this particular numbers. So what we can typically talk about is, for the combo, the average return for the combo has come out to around 0.19%. The standard deviation for the combo has come out to 1.35%, which means the risk of the combination is much lesser than the individual risk. And if I go with the same concept, what is happening to the Sharpe ratio here? The average return minus the risk-free rate of return divided by the standard deviation, resulting in a slightly around 11.8 being the Sharpe ratio in this case. Now, in some cases, this number could be much higher than these two numbers altogether. Now, let's try out what is that best possible combination which will either reduce the standard deviation altogether. So let me try out one combination which is going to reduce the standard deviation altogether, the least possible standard deviation. So that I'll use a tool like Solver, which will try to reduce the overall standard deviation by changing these two things, and with some kind of constraint that these two things should be individually less than or equal to 100%, and these two things should be greater than or equal to 0, and probably I will also put up a requirement that the summation of these two should be equal to 100%, otherwise it could create a problem. So I will try to create one more constraint saying that this particular value should be equal to 100%. So with these kind of constraints, I am going to solve it. And what this is saying is, if I am trying to look out for this combination where the standard deviation has to be minimum, which means a low risk kind of a portfolio, it is better that I invest some 56.51 percentage in HDFC and the remaining 43.48% in Kotak. Means it is giving me a combination which is in line with the least standard deviation, because if I put 100% in this or 100% in this, there is not much of a benefit that is coming out. But on the other side, look at I want to maximize this particular ratio. Instead of minimizing this, I want to maximize the Sharpe ratio. Let's try out. I want to maximize the Sharpe ratio. When I am trying to solve this mechanism, maximizing this particular value, all it is saying is if I have to maximize the Sharpe ratio with this kind of a combination, it is saying that I invest 26% in HDFC and 74% here, which is taking my Sharpe ratio. Let me try looking at it again. The Sharpe ratio needs to be maximized. Okay, this one is minus this. Okay, here it is only 11.58%, but on a maximization, this has become 11.99. So what it is saying is you invest 26% in HDFC and 74% in Kotak. That will maximize your Sharpe ratio. Earlier, the Sharpe ratio was only 11.58. Now it has become 11.99%. So this combination of 2674 is going to improvise your Sharpe ratio. And now what we could typically see is, look at the correlation. The correlation between these two returns, this and this, the correlation is just 0.36. Because the correlation is much lesser, all we are saying is a portfolio approach can really add diversification, it can reduce the risk, and it can increase the Sharpe ratio, which is the reward to risk kind of a ratio. Because Sharpe ratio is nothing but the return which came on the portfolio minus the risk-free rate of return divided by the standard deviation of the portfolio return. Now the first part is excess return over the risk-free rate of return, and the denominator is the risk part. So risk return to risk ratio we are trying to increase by doing the diversification, and when we are doing the diversification, it means that the diversification is coming out because the correlation between the assets is much lower. So that is how we can use in terms of determining the optimal combination of assets to invest in to reduce the overall risk. One option is reduce the overall risk. The second option is increase the reward to risk ratio. Two kinds of workouts I can do. Either I can reduce the overall standard deviation to the lowest, Or I can look at the reward to risk ratio, which is what is nothing but the Sharpe ratio. I can look at maximizing this Sharpe ratio and deciding the optimal combination. So this is how this entire correlation plays a very important role as far as the investments is concerned, right? Now, let's see how it plays a role in terms of trading. A lot of times what we observe is traders, they keep forecasting the changes that are coming in the correlation. So they try to make it on a dynamic basis. They measure the correlation on a dynamic basis. They see the forecasting of they try to forecast the correlation on a regular basis and see when the correlation has really deviated. So as long as, let's say, the correlation between the two is more or less lesser, it is like they are forming a good portfolio. The moment it is increased, they will take the position because there is a change in the correlation and they really want to gain from the change in the correlation. That is what we are calling as correlation based trading. The trading is purely performed to take advantage of the changes in the correlation between the returns of two or more assets. So the trading those assets whose prices are determined to some extent by the movement of the other, where correlation does exist between the two assets. Now here we are seeing the correlation is 0.36. We'll slowly look at if I have to do a trading between these two assets, how do I use this correlation to go ahead with the trading between these two? I'll try to demonstrate that. There are different kinds of correlation based trades we talk about. Most of the times we do what is called as pairs trading. Means one asset would be sold, the other asset would be purchased. That's the reason this mechanism is called as statistical arbitrage. We are trying to make a profit through the statistical trading mechanism, putting in the pairs trading. And there are different kinds of ways in which I can enter into it. One, I have the multi-asset options. Two, we have Quanto options. Three, a correlation swap. Four, buying calls on the index and selling on the individual components. And finally, paying fixed in a variance swap and receiving fixed on the individual components of the index. We'll try to discuss each one of them probably through a better example so that the understanding becomes more and more clear here. First thing, when I look at multi-asset options, in general, they are called as rainbow options. Some people call it as mountain range options. Look at them simple. Let's say I'm taking two assets, S1 and S2. So in this example, let me assume that I am taking HDFC and Kotak. So these two are having their own prices, S1 and S2. And we talk about one strike price K. Now, if with these three instruments, there are so many options that are created. In general, what is an option? We are looking at only one asset. We have a strike price K. Probably if I am looking at a simple call option, if the asset price is greater than the strike price, the difference is what is the typical payoff that is being received. Now, with respect to when we are trying to work out with respect to two securities and a strike price, there are wide variety of options that are created. Majority of them are over the counter. They are not traded on exchange. But all these things fall under the category of rainbow option. Look at them. There could be an option on the better of the two. So whichever is having a higher price, that is the payoff that you are going to receive. Whichever is having the lowest price, you are going to receive that as the payoff. Or we can have an option created, call on the maximum of the two. So call on the maximum of the two. So the payoff is maximum of S1 comma S2 minus K. That is what is the payoff that is going to come. Exchange option, a very commonly used option where the payoff is the maximum of 0 comma S2 minus S1. It's as that's the reason it is called as an exchange is the payoff is S2 minus S1. It's as good as you have given S1 and you have taken S2. So you are selling for S1 some asset. You are getting. I mean you are giving an asset which is worth S1. You are getting an asset which is worth S2. So your payoff is S2 minus S1. And because it's an option, you will exercise it only when S2 is greater than S1. That's the reason it is called as exchange option. We have what is called as a spread call where we are simply looking at the difference between S2 and S1 and K. Whatever is the difference between S2 and S1 minus K, that is what is going as the payoff. And we have a few more options like option on the better of the two or cash wherein the payoff is maximum of S1, S2 or some cash that is typically initially decided itself. Or we have dual strike call option which talks about the maximum of, we have two strike prices there, K1 and K2. So S1 will be compared with K1, S2 will be compared with K2. So the maximum of the two or 0 is typically being paid. Now what we see is in all these options, the major driver is the correlation between the two. Because we are talking about the maximum of the maximum of the two minus K. If the correlation between them is very high, just imagine if the correlation between S1 and S2 is very high, what is that that gets conveyed to us? Either both of them will go up or both of them will go down. Now, if both of them are going down, probably this I may not get anything big because both of them are going down. Even in this maximum of S1, S2, I may not get anything big. Even here, both of them are going down, I may not get anything big. Even here, the same. Only if one of them is going down and the other one is going up, at any point I'll get a higher value. Either in this or this or this or this. So lower is the correlation between them. These kind of options become more and more valuable. If the correlation between them is much higher, there is a big risk that is built into them. Yes, if they are successful, you are going to get much better return. But if both of them are going down, there is a big loss that is coming up. So that is one of the prime reasons. The lower is the correlation, the higher is the value of these kind of options. So which means all these rainbow options, they are highly sensitive to the correlation between the asset prices. The lower the correlation, higher would be the option price, because even if S1 goes down, S2 will go up, S2 goes down, S1 will go up. At the end, they are going to get a higher payoff, and that's going to be more and more consistent. So the value would be much higher. And the way they can very well be defined is the pricing of these kind of options. We can try out using some kind of adjustments to the binomial Black-Scholes model itself. We can take one example to see how we can use, let's say, an exchange option. How we could try to price what should be the price for this exchange option. All of them can be used through Black-Scholes itself. Let's see. Here we are talking of the payoff is the maximum of 0 comma S2 minus S1. Or take S1 out. I can say S1 times the maximum of 0 comma S2 by S1 minus 1. Probably if you remember, the actual call option positioning is 0 comma ST minus K, right? Whatever is the price minus K. K is a fixed one. So by doing this, what did I do? If it had been like this, then probably my S1 is a variable, and because S1 is a variable, I'm not able to use directly the Black-Scholes formula there. But through this mechanism, I have made that S1, instead of S1, by dividing it by S1, I have made it as K, and I have created it in this particular mechanism. Now let's see simply what should be the payoff of the call option here. The payoff of the call option is maximum of 0 comma S2 by S1 minus 1. So because of this, what is going to happen at any point in time, I could see that what are the Black-Scholes variables now? Yes, which is the spot price. The spot price, I will take it as S2 divided by S1. That is my spot price. The strike price X, I will take it as 1. The risk-free rate of return, fair enough, whatever is the risk-free rate of return, I'll take. Now what about the variability? The volatility I have to take for S2 by S1. Right? So if you look at the variance of S2 by S1 or the standard deviation of S2 by S1, it is same as the variance of S2 minus S1. We can see that the variance of S2 by S1, we'll see with if I am trying to find out the variance of S2 minus S1, which comes out as variance of S2 plus variance of S1 minus 2 covariance of S1, S2. Let's look at these two things with the example. Right, now let's say I have this as S1, I have this as S2. Right, S1, and let's say I have taken this as S2. Now what is that we are specifying here? We are saying we'll compute S2 by S1. Now S2, right from here we can compute S2 by S1. So this is what is the value of S2 by S1. So the current value of S, which is the S2 by S1, is the last one. This is the current value of S, which is S2 by S1. And of course S1 I have to take. What is the current value of S1? This is the current value of S1. This is for S. The X, which is the strike price, I'll take it as 1. The risk-free rate of return, I'll take it as 8%. Let's say I'm talking about a 3 months maturity option. So I'll take the time to maturity as 0.25. And now I need the volatility. Now what I'm saying is I can take the volatility of, if I want the variance of S2 by S1, it's same as the variance of S2 by S1 minus 1, and it is also same as variance of S2 minus S1 divided by S1, right? Because we are simply expanding it. So I can very well find out, and if I'm trying to take this S1 currently as constant, I can pull it out and I can simply say it is, and we have even S1 this side, S1 times of this. So I can very well take the variance of S2 minus S1 and I can directly interact here. So let me take S2 minus S1. Now when I'm taking S2 minus S1, it is going to be this one. So I can take the variance of S2 minus S1. So wherein I will take the standard deviation of S2 minus S1, which is coming out to be this much. So this is what is the standard deviation that is coming out. So I could very well, which if you see, take the sigma 1 squared plus sigma 2 squared minus 2 covariance of these two. So if I look at the variance of S1, the variance of S1, this is the variance of S2 if I am taking, variance of S2 and covariance between S1 and S2. If I am taking covariance between S1 and S2, so based on that also, if I really want to find out my sigma, it is directly coming out as the square root of variance of S1 plus variance of S2 minus twice the covariance of S1 comma S2, which is again working out to be the same number. Now if these are the stuff, I can use the regular Black-Scholes formula to typically find out what is the price of this. We know the typical Black-Scholes formula computation for the pricing of the options, right? It's a direct formula. We have D1, we'll have to first compute D1, where we'll take it as log S by X plus, so I'll take it as log S divided by X plus, so that's the way we are, I don't need to compute all of them now. We can directly use the Black-Scholes formula to finally arrive at the price of this call option, and that's how we are using it to compute the volatility part. So and based on this, the price of the exchange options is coming out. So if the correlation between the two is much higher, the price is typically going down. If the correlation is lesser, the price is going up. Or probably here also a straightforward way, I could simply take, instead of going with S2 by S1, now I got S2 by S1, I'll take the sigma of this, wherein I am taking the standard deviation of S2 by S1, which is working out to this number. This is what is working out to be the standard deviation if I am directly taking it here. Now I can directly go with the D1 computation, where I am saying log S divided by X plus R plus sigma squared by 2 multiplied by T divided by sigma into square root of T, right? Now this is coming out to D1, and I'll take D2 as D1 minus sigma into square root of T. This is going as D2, and I can compute n of D1 from the standard normal distribution. I can compute n of D1, and similarly I can compute n of D2. Right, that is probably if you are not aware of this, you can very well follow anything on Black-Scholes formula, any kind of video or content on Black-Scholes formula, which can directly give you the value. So the price of the call option now is coming out as S times ND1 minus x by e power RT times ND2. So this is coming out to be the price of this call option, and of course this entire thing I have to multiply it with S1. This entire thing I have to multiply it with the current spot price, giving me that the price of this call option is somewhere around 158. So this particular exchange option should cost me somewhere close to 158. Now what we are simply saying is, as the correlation between these two is increasing, this value will go down. As the correlation between these two is decreasing, we see that because if the correlation is increasing, both of them will go in the same direction. If the correlation is increasing, either both of them will go up or both of them will go down. What does that mean? S2 by S1 will keep moving in the same direction. If S2, see, if both of them will be more or less constant, not even moving in the same direction. If let's say S2 is increasing, S1 is increasing, the ratio may be more or less constant. So the volatility will come down, and volatility is coming down. We could see that the price of the call option is going to come down. But when I'm seeing S1 and S2 are moving in opposite directions, S2 by S1 will become more and more volatile, right? Because if S1 is down, S2 is up, S2 by S1 is very high. If S1 is up and S2 is down, S2 by S1 is much lesser. So the volatility is going to be much higher. And because of that high volatility, obviously the call option price is going to go up. This premium is going to go up. And that is where the exchange option becomes more and more expensive. That is what we are trying to drive here. The price of the exchange option is going to decrease as the correlation increases and vice versa. The same logic we can try creating for almost all kinds of options, which means as a trader, I'm more and more interested in seeing at what place the correlation is going down, going up, so that I can very well play these kind, I can create these kind of instrument and typically get into the overall trading process. So that's one place where correlation is helping the trading process. Now, another scenario which we could clearly see is another good derivative product or exotic option product that is present, which uses correlation internally, is the Quanto option. See, it's like this. Whatever is the option, a person might have entered into an option contract in a foreign country. So let's talk about a US investor, right? A US investor, he is bullish about India. Now, if he is bullish about India, he really forecasts that Sensex is going to go up. So he wants to invest in the options that are based on Sensex or Nifty. He is bullish about India. He is expecting that Nifty is going to go up in the next few months. So he wants to go for a call option on Nifty. So obviously if the Nifty is going up, he is going to get benefit in Indian rupees. Now, whatever is the payoff he is getting in the Indian rupees, with this, if let's say even the exchange rate has gone up, right, with the market going up, let's say even the exchange rate has gone up, what is happening? By the time he is converting this payoff back to his domestic currency, that benefit, whatever Nifty increase the payoff has given, it is completely going off. So that is the risk. So that is where this Quanto option is coming to picture. What it says is, you take the payoff from the Sensex, whatever the payoff the Sensex gives, it will be converted into your domestic currency at a fixed exchange rate. We will fix the exchange rate and it would be converted to your domestic currency at that fixed exchange rate. So even if the exchange rate has gone up, it would be converted at a lesser exchange rate itself, which means you are going to get we are going to get more dollars for it, right? If the exchange if the payoff is higher, even if the exchange rate has gone up, even if the exchange rate has gone up, you will go for a fixed exchange rate itself, which means you will get higher dollars. But suppose if the exchange rate has gone down, now it's just an option. You will not exercise this option at all, which means you will still go with the market exchange rate, still getting the higher dollars itself. So the Quanto investments are primarily, Quanto options are primarily helping the domestic investors to invest in the call options of a foreign country and at the same time converting it back into the home country by fixing the exchange rate. That is what is the concept of a Quanto option. For example, a US investor, he believes that Nifty or Sensex will increase, but at the same time the rupee will fall, which means the exchange rate is going to go up. In that case, he'll buy a Quanto call on the Sensex with the INR payoff being converted into a US dollar payoff at a fixed exchange rate. Now, which means in this, what are the uncertainties? One, what could be the payoff that could get generated on the Sensex or the Nifty? By what extent it is going to go up? And at the same time, what is the rate at which the exchange rate is going to go up by that time? Because this will be converted into the domestic currency at this exchange rate, whatever is prevailing on this particular date. So there are two unknowns, and that is where the correlation between these two unknowns is very much important. Now, if you see, as the Sensex goes up, let's say even if the exchange rate is also going up, what does that mean? The Quanto option will become more and more valuable because the Quanto option is giving an option to convert it at a fixed price. Now, if I know that as the exchange rate is, as the Sensex is increasing, as the index is increasing, if I say that even the exchange rate will increase, means the foreign currency will depreciate. If I am saying that even the exchange rate will increase, that is where I could see if the Sensex is increasing and the domestic exchange rate is also increasing. So what we could clearly see is the price for the Quanto option is going to decrease. The reason being, the moment you are converting it into the domestic currency, no, here it's the INR increasing. Sorry, it's not the exchange rate increasing. Let's say the rupee is becoming more and more stronger. So the dollar is decreasing, depreciating, and the rupee is appreciating. What is typically happening? Let's assume that today 1 US dollar is equal to 60 INR. Now the rupee is appreciating. Let's say it has become 55 INR only. $1 has become 55 INR. Rupee has appreciated. Now, if the Sensex has gone up, and the rupee has become only 50, the dollar has become 55 INR. Means whatever that excess payoff I have got, I can quite comfortably convert it into US dollar, and I am getting more dollars because now the rupee is only, dollar is only 55 rupees. I am able to get more and more dollars. So in that case, I am not preferring any kind of Quanto option. The value of the Quanto option is going to go low in that case. But if I assume that these two are negative, mean the exchange rate between India and US dollar. US dollar is going to strengthen, Indian dollar is going to weaken. So if the Indian dollar is weakening, Indian rupee is weakening, as the Sensex is going up, now the number of rupees per dollar is also much higher. Converting it back into US dollars, I'm not getting any kind of a benefit. In that case, I'm going to opt more and more for a Quanto call option. That is where the Quanto call option is going to be more and more expensive. So again, correlation between the index and the exchange rate or the currency movement with respect to another currency is really helping people to make trading decision. Even this can very well be priced using the Black-Scholes models itself. Then the other kind of instrument that can come into picture here is the correlation swap. Here it's again a straightforward thing. A and B are getting into a swap agreement. A and B are getting into a swap agreement wherein A says, I'll pay a fixed correlation. Right? We'll talk about it. I'll pay a fixed correlation and I'll receive a realized or actual correlation between the two assets. So whatever, which means just like I pay a fixed interest, I'll receive a floating interest. So in a correlation swap, I'll pay a fixed correlation, I'll receive a realized correlation. This could be on one single security or this could be on a portfolio of securities. Right? Now, on a regular basis, the correlation is typically computed. So it is a direct trading on the correlation itself. So whosoever is paying fixed correlation, we say that he is buying correlation, and whosoever is receiving fix, we say that he is selling correlation because he is receiving the fix. And why buyer? If the correlation is more than the fixed amount, if the realized is more, so this party is receiving a higher correlation multiplied because this party is gaining if the correlation is increasing because he is paying a fixed correlation, getting a realized correlation. So if the correlation in the market is increasing, A is going to get the benefit, and if it is decreasing, B is going to get the benefit. And in case we are looking at a portfolio, we see that the realized correlation we are computing in this mechanism. If there are three assets in a portfolio, if there are only two, I'll take, let's say the correlation is this much, which if you see in the formula as well, I'll take it as 2 divided by 2 squared minus 2 into correlation, summation of the correlation between 1 and 2. So it's becoming 2 by 2. So 1 times correlation between 1 comma 2. But if I had 3 assets, the way I am trying to do is 2 by 3 squared minus 3 times the average correlation between these, which is coming out as 1 by 3 times the average of the correlation between each one of them, because there is a possibility of correlation between 1 and 2, correlation between 1 and 3, and correlation between 2 and 3. I take the average of them. So that is the reason we are using this mechanism. Even if you say for 4, it is coming out as 2 divided by 4 squared minus 4, 2 divided by 12, which is 1 by 6, because when there are 4 assets, I get the correlation between AB, AC, AD, BC, BD and CD. 6. So the 6 correlations I am simply doing 1 by 6. So it's a simple average correlation, average pairwise correlation I am taking, and that is what I am trading with respect to a fixed value. And whatever is the difference, we are simply multiplying it with the notional amount, and that is what is the typical payoff that is happening with the parties. Logically speaking, a very interesting statement here, this correlation swap is actually protecting against the decreasing stock prices. if we see correlation is high, when can the correlation be increasing? We have discussed that in a normal market, any stock that was having any pair that was having a lesser correlation, when the markets are typically falling, the correlation between them is going to increase. That is what we have seen even in the recent economic crisis as well. So when the markets are typically down, the correlation relationship will break, and whatever was the lesser correlation earlier is going to turn around into a higher correlation now. So the stock prices typically when they are falling, the correlation will be higher. Right? Generally when the entire market is falling, we see that the correlations will be higher, and when the correlations are higher, the person who has got into a buying of a correlation, fixed correlation pair is going to gain there heavily. So it is simply said, getting into a correlation swap, it is going to indirectly protect against the decrease in the stock prices, because the correlation between the stocks generally increase when the stock prices are falling. That is what we could see. Now if I want to really look at the correlation swap, right? If I want to look at the correlation swap here, the correlation between the two is 0.36. So let's say I will exchange it for a fixed 0.36, but I want to go on a variable note, right? I want to go on a variable note. I see that at regular points, depending on how the correlation is changing, I want to go with the investment accordingly. So for that, what is that I would like to look at? I would like to go with the covariance measurement between the two. We'll use that Garsh model or EWMA kind of models, right? Wherein I'm going to consider first the covariance. So initially I can take the covariance being xy, recollecting the Garch kind of models which we have used. So I'll take xy as a multiplier of these two things. So this is what is going to give my xy. Right, this is what is going to give my xy. Where if you look at the way we use the Garch models, we say covariance between x and y, we take it as xy, my expectation of xy minus expectation of x multiplied by expectation of y. This is what we are taking. And here also what we have said is for smaller values I can very well assume that these two things are 0. So I'll simply take the expected value of xy as a covariance of xy, and instead of taking a plain average, I'll try to go with a weighted kind of an average in an exponential fashion. The same way for variance, I'll consider x squared, I'll consider y squared in the same manner. So this is what you can refer to a Garsh model process or EWMA model process to typically compute. So if I really want for x squared, I'll take the x squared as this particular number, y squared as this particular number. So I'm getting x squared, I'm getting y squared. Now based on this, we can talk about covariance of x, right? Covariance between x and y. For the first day, I'll try to use it using this variable itself. For the first day, I'll take the covariance as directly xy itself. But from the second day onwards, I can actually give some kind of weightage, right? I can give some kind of weightage. So let me take a weightage of lambda. So let me take it as 0.5. So what I'm typically doing is I am giving this lambda weightage to the previous period's xy plus 1 minus lambda weightage. I'm giving 1 minus lambda weightage to the covariance of the previous period. That is what we typically do in arriving at EWMA kind of model. For time being, let me use EWMA model. So this is what is the numbers for covariance that have come out. Similarly, I can work out with respect to the variances, right? Even the variances also I can do the same thing. For each of them, I can compute the variance. Again, with the same logic, I'll use lambda factor, multiply it with the x squared of the previous plus, the x squared of the previous, and I'll take 1 minus lambda and I'll multiply it with the variance as of the previous period. So this is what is going to give me my variance on a variable basis. Similarly, I can compute the variance of y. So this I'll call it as variance of x, and this I'll call it as variance of y. So this also initially I'll equate it to y squared, but after that I'm giving lambda times the y squared of the previous period plus 1 minus lambda times the variance of the previous period. So this is working out, here either I can take the variance, probably instead of 0, even here also let me consider the xy here, even here let me take x squared only. So this is what is working out to the variance of y. Now that is where I'll even go with correlation between x and y. I'll take it as the covariance between x and y, and I'll take it as the standard deviation. So I'll take the square root of the multiplications between these two things. So this is what is working out to be the correlations between x and y. I'm having the covariance and I'm dividing it by their corresponding variances. So this is what is boiling down to the correlation. Now all we are saying is I need to optimize this number so that I get better correlations, and the way I optimize it is I find out the log likelihood function. So I'll take the log likelihood per x, right? I take the log likelihood with respect to the returns. Or for the x I can take the log likelihood, for the y I can take the log likelihood, going with the normal distribution assumption. And we know that normal distribution will have an equation 1 by root 2 pi sigma squared e power minus 0.5 times x minus mu by sigma whole square. Because mu we have assumed it as 0, it becomes 1 by root 2 pi sigma squared times e power minus 0.5 times x squared by sigma squared. So if I'm taking the logarithm, yes, log 1 by root 2 pi, I can take it out as a constant, and log 1 by root sigma squared minus 0.5 times x squared by sigma squared. This is what is typically coming out, and I can maximize this particular expression. So with respect to x, I can very well find out. With respect to x, it is coming out as log 1 by square root of sigma squared. This is the sigma squared with respect to x. and minus 0.5 times x squared by sigma squared. Minus 0.5 times x squared divided by sigma squared. Right, so this is what is coming out. Log of this minus 0.5 times x squared by sigma squared. So the log likelihood is coming out to these kind of numbers for x, and similarly I can go with the log likelihood with respect to y, applying the same logic. So logarithm of 1 by square root of y sigma squared for y minus 0.5 times x squared, which is the y squared, divided by sigma squared, which is the variance of y. So this is coming out as log likelihood function for y, and the total log likelihood, right? Total log likelihood, if I want to see, it is the summation of all these things. And my intention is to change this lambda so that I get a maximum value for this. So I'll be using the solver, where the intention is to maximize this log likelihood by changing the value of lambda. That's it. By changing the value of lambda, for which the lambda, probably one constraint that I can put, the lambda should be less than or equal to 100%, and the lambda should be greater than or equal to 0. Probably I'm adding just two constraints. Solving it, I'm getting my lambda as 0.08, where the log likelihood is coming out to this, and this is how I'm looking at the correlation. Now what we are typically saying is the current correlation between the two is somewhere around 0.46. So now as the correlation, see, now you see that at different points in time the correlation was changing in a different way. I have frozen the correlation in the correlation swap at around 0.36, but now it is 0.46. So as a buyer of the correlation, I have really gained, and as a seller there is a loss. So this is the typical way a correlation swap gets completely priced. And what we see is even today, there is no standard valuation for the correlation swap determining what should be that fixed correlation. Right now I have just in the example, we have decided that 0.36 is the correlation, but there is no Black-Scholes kind of a pricing model to typically value the correlation swap. What should be the fixed payment, fixed correlation, which should typically get in. That is where people are using the historical data, anticipating something, and based on that they are using their own simulation based models and term structure based models, which are internally developed to try to simply come out with the correlation swap fixed pricing. Because if I have to really talk about fixed number, I require the term structure of the correlation. Okay, 1 year later, what could be the correlation between these two? 2 years later, what could be? So unless I have a term structure for the correlation, just like we have a term structure of interest rates, there can't be any kind of a mechanism which can be used for getting into the fixed correlation portion of the correlation swap. That's one thing about this particular instrument. Then we have a couple of other strategies which talk about buy call on the index, take a call option on the index, and sell a call option on the individual components. Now what it clearly says is, if the correlation, see, generally what we see is the correlation is much higher between the correlation and volatility. What does that mean? If the correlation between the stocks is higher, right? If the correlation between the stocks is higher, what we also see is the implied volatility on the call is going to increase. Why? The correlation between the stocks is higher, which means all of them are either going up or all of them are going down. So the volatility of the index is increasing, right? Because the correlation between the different stocks that are there on the exchange or on the index is going up. What we could typically see is all of them will move in the same direction or all of them will move in the opposite direction, which will definitely result in overall volatility is typically going up. And that volatility going up, we see that the call option premium is going to go up. So the call option value is typically increasing, which is going to be giving a positive value. And obviously on the individual stocks, whatever is the potential loss that is coming, that gets completely outperformed. So that's the reason this is again a way to play on the correlation. Good trade in medium and long term can be disastrous in the short term. Sometimes there are some securities which exhibit a good amount of correlation in the long term. They may not have anything now or vice versa. The same logic, you pay fixed in a variance swap, you get into a variance swap saying I pay a fixed amount of variance, I receive whatever is the market variance on a notional amount. Again, this payment is on the index. So I say I pay fixed variance of this index and I receive fixed variance on the individual components. Again, the same logic, if the correlation is increasing, the variance of the index is going to increase. So the variance of the index is increasing, the present value of the swap is actually increasing for the buyer, which means what he is receiving is typically going up. So all these kinds of strategies that are being performed, they are exclusively targeted towards different kinds of trades using the correlation itself, right? Now, let's move on to trying to understand how correlation plays a role in risk management. Till now we have seen how correlation is helpful for investment, how correlation is helpful for traders. Now we are seeing how correlation is helpful in the risk management. We know the process of risk management is nothing but identifying, quantifying, and if possible reduce the financial risk. And we know there are so many kinds of risks: market risk, credit risk, and today correlation risk is also one of the major risks which requires to be handled heavily. See, generally what we see, probably if I am trying to link the correlation with market risk, we know that one of the widely used measures for market risk is value at risk, or sometimes it is being expected shortfall is being used. Now when I look at this market value at risk, what is the typical formula for value at risk? We were looking at the standard deviation of the portfolio multiplied by the Z level, which is the standard normal distribution value at alpha by 2 significance level, and square root of time. If I want a 10-day var, I will take it as square root of 10. Now, simply put, this particular value is purely based on the correlation between the asset. Right? The sigma of the portfolio is purely based on the correlation of the assets. If the correlation is much higher, this number will be much higher. If the correlation is lesser, even the standard deviation is much lesser. So the value at risk, which is a measure of the market risk, apart from the individual volatilities, it is heavily dependent on the correlation that is existing between the different asset classes. So, which means there is a usage of correlation even in understanding the market risk, which means in risk management also understanding the correlations between the various asset classes will help me in terms of coming out with an appropriate value at risk. The same logic goes with expected shortfall as well. because in an expected shortfall also we are trying to measure the tail of the distribution. We are trying to see what is the expected loss within the tail. Now this tail values will be higher if the standard deviation is higher, they are lower if the standard deviation is lower. And again, the standard deviation is lower if the correlation between the assets is lower. So which means determination of the market risk is very much dependent on the correlation. So two asset portfolio, we can find out the market risk. So probably if I am having the same portfolio, right? If I have to look at the value at risk on this particular portfolio, all I have to look at is the standard deviation of the portfolio here, which happens to be, let's say this is the portfolio 2674 combination. I'll take the standard deviation of the portfolio multiplied by, if I'm going with 99% confidence level, right? If I'm going with 99% confidence level, then this Z value will be 2.33. So I'll take it as multiplied by 2.33 and I multiply it with 10-day VAR. So I'll take it as square root of 10. So this is what is going to be my 10-day VAR. But what we are simply saying is, if the correlation is higher, obviously this value would be slightly more higher. And if the correlation is higher, obviously this value at risk is going to be higher and vice versa. So that's one of the prime reasons the risk management world understands the correlation between the very different asset classes. They have to do it in an effective manner. And the Basel also typically has come out with a requirement that you have to hold capital in the trading books, which is at least 3 times the 10-day VAR. So if the 10-day VAR is 0.10, then the 3 times of it, which is 0.30, is the kind of minimum capital that needs to be held, along with some kind of specific charge for credit risk. That is what is the typical requirement of the Basel 3 as a part of the capital requirements. And what we are simply saying is, if the correlation is much lesser, the standard deviation is much lesser, which means the value at risk also will be lesser. So the value at risk, which is one of the interesting or important components as a measure of the risk management, as a measure of risk, is again entirely dependent on the correlation between the various asset classes. So that's where correlation has its role in risk management as well, right? Now, the next dimension is the global financial crisis. To what extent correlation plays a role in the crisis? Let's quickly look at the key reasons why the crisis has come out. I'm not going deeper and deeper into the story, but on a broader note, right from 2003 to 2006, the credit spreads were much narrow, the interest rates were much narrow, the volatility was much lesser. So this kind of an environment, and that too the real estate prices were booming. All these things put together, the investors, they started taking more and more risks. They started getting more and more into speculations, and they wanted to benefit from this. So every segment, it has resulted in a boom. A bubble started coming up in almost every sector of the market. Now it even shows, the numbers quickly show that people on an average have borrowed 470% of the national income of US for doing these speculations. Means 4.7 times the total national income of the country have been borrowed for speculatory investments. And taking advantage of this, new class of investment products have been created. The CDOs, the options on credit default swaps, different kinds of instruments have been created with so much of complex features built into them. And even the Coppola correlation model has been newly created, where the correlation of all NC2 assets in a structured product is typically being computed and typically used for the trading purpose. The rating agencies got into a moral hazard because on one side they are rating a particular agency or particular CDO, and on the other side they are taking money from that. So this is a kind of conflict of interest which has resulted in almost all the rating agencies giving a decent AAA rating to all the CDOs, which looked as if they got completely overrated. And even the managers, regulators, everyone, they have lowered their standards. Even from the bank's perspective, they have got into subprime lending. So they have completely lowered their standards with respect to understanding the credit risk of each of the borrowers. So across, even from the investors' perspective, they have lowered their standards and got into those kind of investments whose ratings were not up to the mark. So, how did correlation influence this entire scenario? Because our objective is correlation, I would like to talk completely on how correlation has influenced this entire scenario. In 2003, everyone wanted to take a risk. So, the complete speculations came up in terms of the real estate market, especially the residential mortgages segment. And all the residential mortgages are packaged and they have been sold to the SPV who has created the CDOs, the collateralized debt obligations. And the CDOs have been packaged in such a way that if different investors at different risk levels, they can choose which one is suiting to their risk levels. And even a new correlation, Coppola correlation model has come out, which clearly it is able to manage the default correlations in the CDO. Now look at this. In 2005, a couple of key securities, key companies, they got a downgrading to junk status from investment status. The bonds of Ford and General Motors, they got downgraded to the junk bond status from the investment bond status. Now, what does it happen? Correlation in the bond. Now, when we see that the credit rating is going down, credit ratings have gone down. Now, look at the CDO composition. CDO which got a AAA rating, it's almost, it should be correlated with those kind of bonds which are investment grade. But the CDOs now, which have to refer to this investment grade bonds, now because of Ford and GM being downgraded, their correlation with respect to the investment grade bonds has actually gone down. The correlation in the, because of the investment, their correlation between the investment with respect to the investment grade versus the CDOs has actually gone down. And that is the reason the bond prices have gone down completely. And the huge losses went to the hedge funds who were short. The hedge funds had followed a kind of a strategy that they have short the equity tranche and they have longed the mezzanine tranche. Now think of this. Correlation, when the correlations have gone down, okay, look at this. Correlations have gone down. Now equity tranche, the spread has increased sharply. Why? Look at this. When the correlations of the mortgages in the CDOs have actually increased, right? So there is a chance that either all of them will default or none of them will default. So if all of them are defaulting, the equity tranche is losing drastically. If all of them are not defaulting, the equity tranche is gaining drastically. Now, these two put together, the volatility of the equity tranche is increasing. And at the same time, because there is some level of possibility that all of the bonds may not default at all, the value of the equity tranche is increasing, because now there is a possibility that even none of the bonds can default, none of the mortgages can default, because the correlation between them is very high. So the possibility is either all of them will default or all of them will not default. At least some case that all of them may not default. If all of them are not defaulting, obviously equity tranche is getting the money. Whereas if they have very less correlation, at least some of them are going to default at any point in time. And because at least some of them are going to default, the equity tranche there is a chance that the equity tranche will not get any money. So when the correlations are typically higher between the various bonds, the chances that the equity tranche will get some money is going to increase, and because of that the value of the equity tranche is increasing. But at the same time, it's not that the securities are increasing but the bonds are not defaulting. All the bonds are actually defaulting. So because of the defaulting, probability has actually gone down. Whatever the increase in the value of the equity that came out, that did not work out, which resulted in the spread actually increasing sharply, and people who have invested in the equity tranche, they have lost heavily. But at the same time, again, with respect to mezzanine tranche, what has happened? See, if the correlations have increased, right? If the correlations have increased, logically, either all of them will default or none of them will default. If none of them, if none of them, if all of them are defaulting, there is a chance of loss to the mezzanine tranche. Whereas if the correlations were lesser, only few of them are going to default, and few of them are going to default, the equity tranche will absorb that loss. But only when all of them are going to default, the loss will get percolated to the mezzanine tranche. So because few of them are, if the correlation is lesser, only few of them can default, the value of the mezzanine tranche is going to be much higher during that case, whereas for the equity tranche during that case the value will be much lesser. Whereas when all of them are going to default or none of them going to default, the equity tranche will have a higher value, mezzanine tranche will get a lower value. And because of that, whosoever has invested in this kind of a position, they have short on the equity tranche and long on the mezzanine tranche. In mezzanine tranche, they have lost the value. In equity tranche also, they have lost the value. So both of them, because when the correlation has decreased, the loss came out on both the positions. When the correlations between the CDOs and the investment grade, CDOs and the investment grade, if the correlations have decreased, both the positions have got into a loss. And even the correlations within the mortgages, within the different instruments, it has increased. Even that the same story, even they have lost on the equity tranche, and also there is the equity tranche, the value has gone up, the mezzanine tranche, the values have gone down. So the correlation between the tranches of the CDO also increased. The super senior tranches, they got affected, because now the correlations have gone up. There is some chance that all of them can default. So the value for this senior tranche, if all of them are defaulting, some loss is going even to the senior tranche. So overall credit market deteriorated, and even the super senior tranches, they lost very heavily. So in a whole, it is clearly telling us that correlations, if they are changing, especially in case of crisis, we see this kind of huge losses being piled up to the investors. And probably just to understand what are the different, who are the different parties who are responsible for this, there are different dimensions. One, the quantitative experts who have created the new products, the management and the traders who have authorized and conducted the over investing and extreme risk taking without putting any kind of limits. So they were purely speculative on their positions and no one was controlling the speculations of their positions. Rating agencies who have compromised and given AAA rating to many of the CDOs, regulators, any kind of overinvestment they have simply approved. Risk managers got into excessive risk taking. Irresponsible leverages have been taken. Excessive tradings performed. Huge risk takings came up. It has even said a few countries who have borrowed 10 times their GDPs, like Iceland, which has completely gone into bankruptcy. After that, even the Lehman Brothers were maintaining some kind of a leverage of 30.7, which are clearly indicating that the risk taking levels were very extreme instead of doing any kind of risk management, and things did not go well because during the times of crisis the correlations even increase and make things even more worse. And coming to one more dimension, regulation, how correlation plays a role in the regulation, especially we see for market risk and credit risk, there is a heavy usage of correlation. Just to understand, as a part of the Basel, it is a pure regulatory guideline to stabilize the banking system, though it has no legal authority. Most of the countries have created the legislations to enforce Basel. And what is clearly seen in case of Basel is any kind of incentive can be, I mean, generally the Basel has come out with the mechanism in which it can incentivize the banks to enhance their risk measurement and management systems. So the contribution to a higher level of safety and soundness in the banking system is one of the key objectives of Basel. So what we typically see is in the Basel 3, new ratios have been computed to ensure liquidity and the adequate leverage of the banks. New correlation models are going to come up as a part of the Basel 3, especially defaults in multi-asset portfolios, correlation in derivatives transactions, which are typically termed as credit value adjustments, the correlations with respect to wrong way risk, they are going to come out with some kind of correlation related standards as a part of the Basel 3, which is going to be implemented until 2018. Now, just looking at how correlation is linked with other forms of risk, we have already discussed about the market risk. It's an integral part of the market risk because VAR, value at risk, typically takes the correlation between the assets. So correlation is inbuilt. The same logic goes with the expected shortfall, which is also called as conditional value at risk or tail risk. Even that which is typically trying to focus on extreme events, the average, the expected losses beyond a certain level, that is what is being mentioned as a part of expected shortfall. Even here, this particular number, which is that beyond the limit, is purely dependent on standard deviation of the portfolio, which again is purely dependent on the correlation between the assets in the portfolio. So correlation has a bigger role to play in market risk. Similarly, when we are looking at credit risk, we can see as a part of, generally when I talk about the credit risk, we bring in either a migration risk or the default risk. Now, what we generally see is any lower grade bond. If the bond is having a C kind of a credit rating, or B kind of a credit rating, which is a junk bond status, the value of the asset will be much lesser. So as it keeps going and going down and down, the lender is going to lose. And even there is a possibility of default correlation between the two bonds, which brings out the degree to which the defaults occur together. And if they have given two loans which are highly correlated, there is a good chance that both of them default, both of them don't default. So that's a big loss to the lender. So if the default correlation is much lesser, that is what the creditor is going to prefer. So that the measuring the correlations between the different kinds of debtors, different kinds of loans is very much essential to mitigate the risk for a lender. So if at all you are lending more and more to the same industry, it is very much possible that the probability of default of all the companies in one single industry could be much higher. So if one company in an industry is defaulting, there is a good chance that all others are going to default. So, but at the same time, between the industries also, let's say industry X and industry Y, it is observed that even this is positive. But what we are simply saying is this number is slightly lesser compared to this number, which means the correlation between the sectors is slightly lesser than the correlation within the sectors, which means there is some kind of an incentive to diversify across the sectors. And systemic factors are having a greater impact because even between this and this, if the correlation is very high, then it means across the economy there is the economy is playing a bigger role in terms of default. The economic situation going worse, all of them are going worse together. Economic situation is improving, all of them are improving together. So there is a kind of sector specific role. Sector diversified loan portfolio is slightly better off to reduce the correlation risk, but overall also we could see some kind of interaction between the various assets in the various assets in the portfolio, which means the higher the correlation, even any amount of diversification done, it may not reduce the risk at all. And when we look at one more dimension in terms of term structure of the default probabilities, it is from the historical data, it is observed that this is going to increase with time for investment grade bonds. Today they may be investment grade, but if I am talking about a longer term, at some point or the other, they may be exposed more and more to adverse conditions or external event. So there is a possibility of they having more and more possibilities of downgrading in the future. Whereas when I am looking at a distressed ones today, in the short term, they may have a very worse credit ratings, but in the longer term, if they are going to survive the crisis now, they are going to improve their ratings in the future. So these two again can form a better portfolio. Some of them which are investment grade and some of them which are distressed, because the chances historically that something which is an investment grade can go into a speculative grade and vice versa. So they again, the correlation between them is lesser, which again goes as a part of the good portfolio building process. Then looking at the other dimension, which is the systemic risk, we have seen the 2007 collapse is a good example of correlation playing a role in the entire systemic risk. Entire financial system is collapsing. The whole market has frozen, no lending activities except for a few sectors like consumer staples and education. One, consumer staples is required even whenever the economy has gone down also, so that particular sector, especially Walmart, which was operating in that particular sector, it is the only company whose stock price did not go down even when the whole economy has gone down. Right, and similarly a few of the education sector stocks, they did not go down during the crisis because people became more and more unemployed, and they thought that is the period where they can very well use it for better education, improving their skills so that they can be fit to the industry once the market opens up. So these two sectors were doing extraordinarily well during the crisis, and of course the health sector also has done decently well during the crisis, but remaining all sectors have collapsed quite drastically, which means the correlation between them was much higher. One, because the GDP was decreasing, unemployment was increasing, so overall standard of living of the people has gone down drastically. So what is the simple logic from there? portfolios that are considered as well diversified in good times, they have experienced a sharp increase in the correlation during the crisis. So understanding correlation will really help us to avoid the systemic risk as well. And looking at one more aspect, the concentration, the more and more, if two securities are highly correlated, it means investing in this and investing in this is more or less the same. So I'm concentrating only in one single asset kind, though I have bought in two assets, but because the correlation between them is same, my exposure is typically a concentrated exposure itself. So if I gain, I'll gain heavily. If I lose, I'll lose heavily. So the intention again is go for a lower concentration ratio, because the default risk is more and more diversified, and that would reduce the risk of default altogether. All these things are clearly sending signals to us that correlation in the financial world plays an important role, right from the investment to trading to risk management to avoiding the crisis, and even as a part of the regulation. So that is the importance of correlation. All right.